So look, I think the mood is more somber this time around than the previous two conferences. And in some ways it's good because there is a realization amongst the corporate as well as with the investors that the economy has slowed down. Earnings have not yet come through, and in fact most of the high frequency indicators also indicate that the softer patch may last for a longer period of time. And the backdrop is against a very difficult global environment right now. There is a trade war between US and China. The global economy is slowing down, and that also makes it a bit difficult because at the end of the day there is a reasonable amount of exports that we depend upon. The good thing out of that is that oil prices are down globally as a reflection of the slowdown, and interest rates are coming off everywhere in the world. In fact, the Fed fund futures are already discounting about 70 to 80 basis points of rate cuts. So that also provides in some ways more room for monetary stimulus in many countries, including India, particularly against the backdrop of a lower oil price. So in summary, the mood is somber, there is a realization there is a slowdown. At the same time, as compared to many other large economies in the world, India possibly offers a more attractive destination for overseas flows.
You are making a case that there is one should be looking at, or positions should be made towards domestic cyclicals, because the environment is such that global cyclicals obviously may not do that well. But if you look at the domestic cyclicals, the sector which come to fore are industrials, some capital goods, automobiles, interest rate sensitive. How do you rate them in terms of priority, and the business case is stronger there in the current environment?
So look, our strongest preference is for the large corporate lenders. That's in the private banks as well as the large, one or two of the large state-owned banks. And that's really our focus because we've seen one of the most challenging NPL cycle in India over the last 4 to 5 years. In fact, impaired loans peaked out at around 12 to 14%. Now they're back in single digits. The credit costs for the large corporate lenders were in the 250, 300 basis points range, and they're coming down quite significantly, at least as per our forecast. At the same time, they're taking share away from the inefficient state-owned banks and the non-banking finance companies, many of them at least. And we will have a very interesting combination of credit growth being concentrated with the large corporate lenders, even if the overall system doesn't grow. The NPL cycle receding at the margin for the banks at least, and the credit costs coming down. So an acceleration in pre-provisioning operating profits. So that is our big call, and it has been for some time now, for a few quarters.
It has worked,
and it's worked extremely well. Other than that, it's really about select companies in different sectors which are available at reasonable value. And it's not really sector specific, but industrials and infrastructure look good given the kind of policy continuity we expect and the focus on infrastructure that the government has always had.